Hey, what's up everyone? This is Silver Slayer. Thank you for tuning into this video. Fed's coronavirus response is good for gold. Good news for gold and silver as the Feds make more statements following COVID-19 and where we're going to take this. It looks like we're going to be in quarantine until May 1st, and other statements said by them is making people drawn towards precious metals as this safe haven alternative. So anyways, let's jump into this article. Let's just get right into it. Make sure to smash the like button. Gold remains vulnerable to news-related volatility in immediate terms. Gold's intermediate trend, however, is supported by the Fed's latest QE. Hyperstimulus in the past doubled gold prices and could happen again. So in the wake of the broad equity market correction, gold prices have been extremely volatile and the metal's short-term trend is still uncertain. But, as I'll explain in this report, there is little doubt that its intermediate-term 3 to 6 month outlook will benefit from growing demand among investors looking for insurance against a weak global economic outlook, as well as from the Fed's aggressive response to the coronavirus. So, in the next 3 to 6 months, we could see extremely beneficial silver prices, and they explained it as benefits from growing demand among investors. This money coming into the markets will push prices higher, along with the Fed's aggressive response to the coronavirus. So while gold has mostly benefited from safety-related demand over the past 4 months, it was briefly caught up in the panic selling surrounding the U.S. coronavirus outbreak in early March. Many retail and institutional investors were forced to liquidate gold positions in order to raise cash to cover losing equity in corporate bond positions and to meet margin calls. This resulted in gold future prices dropping 13% over a 6-day period last month. So that explains that huge drop in precious metals. So just as quickly as gold fell, however, it bounced back from recovered almost all of its losses in a 3-day period between March 22nd and 25th. The speed and intensity of this upside reversal highlighted investors' recognition that once margin calls and forced liquidations were over with, gold is one of the safest places for the remaining assets to be parked once financial market storm finally ends. So once all this stuff blows over, gold is the safe haven, but in the middle of it, things could get a lot of volatility, a lot of craziness and controversy happening. So nevertheless, gold investors got a jolting reminder that this is still an extremely choppy market environment as bullion prices slid 3% on Tuesday in response to Asian financial market weakness, as well as Russia's announcement that its central bank would suspend gold purchasing beginning April 1st. And that is not a joke. That's not an April Fool's joke. So as Kitco News pointed out, World Gold Council data showed that Russia purchased 158 tons in 2019, as well as purchasing an additional 8 tons in January of this year. The oil-dependent economy is severely contracting thanks largely to collapsing energy prices. Its ruble currency has also been collapsing in the last several weeks as its domestic economy weakens, and you can see this right here. So while gold has suffered some near-term residual weakness in the wake of Russia's woes, the yellow metal still managed to close out the first quarter 2020 in the black, its 6th consecutive quarterly gain. Even without Russian central bank demand, there is still plenty of demand from investors around the world who are desperately seeking portfolio protection as COVID-19 and recession fears continue to mount. So we're on a global scale now. This isn't just Russia. This isn't just USA. It's not just China. We're on a global scale for this stuff, right? This is a different ball game right now. More importantly, the U.S. central bank's all-out attempt to provide as such liquidity as the financial system needs in this time of crisis will ultimately bolster gold prices. The Federal Reserve recently stated that it would buy treasury bonds and mortgage-backed securities in the amounts needed to ensure that credit markets remain stable, including $1.5 trillion worth short-term loan offerings to the banks address highly unusual disruptions in treasury financing markets associated with the coronavirus outbreak. Commenting on the Fed's hyper-aggressive response to the crisis, Jason Mayer of Sprott Asset Management observed, "This is very good news for gold bullion and gold equities." And anytime I'm talking about gold, also follow suit with silver, right? I'm talking about silver as well. There's an 80% correlation between the Fed's balance sheet and the price of gold bullion. Similar to what occurred during the GFC, the gold bullion should move first, followed by gold equities. So you can see in the chart here. The red line represents the credit outstanding in trillions, 5.15 trillion as of 3/27/2020. The yellow line is the gold spot price with the gold commodity index. The blue line is the price of gold mining equities represented by the GTX. So as Mayer noted, gold has historically performed well in the wake of plunging interest rates and abundant U.S. central bank liquidity efforts. Indeed, the gold price nearly doubled from the start of the first quarter in November 2008 until quarter two, second half of 2011. Mayer believes that based on Fed's unprecedented response to the latest crisis, gold bullion could dwarf the second half of 2008, which saw the metal dramatically outperform global equity markets. And they're referring back to 2008, 2011, the 90s and the 80s, when there's a recession/depression looming around the air, when stock market volatility was at all-time highs and what precious metals did and how they performed. So turning our attention to the iShares Gold Trust ETF, when last examined, this popular gold tracking vehicle last week, it rallied 5% on March 24th, one of its best one-day performances ever. I noted, however, its explosive rally could also be viewed as a case of too much too soon in the immediate term, and that IAU may need to spend several days consolidating its latest gains before it tries to overcome the previous high from March 9th at $16.04. This observation still stands as we enter the month of April, as it's clear some additional consolidation it needs before the gold ETF is ready to commence a sustained rally. And they're talking about building up and holding its prices there. So, moreover, IAU remains vulnerable in the near term to news-related volatility. In the view of this, I don't recommend plunging in and buying with both hands yet. However, nibbling on some weakness can be done by investors with strong stomachs. Otherwise, I recommend to conservative investors waiting for the market to firm up and for that extreme volatility to diminish before backing up the proverbial wagon in the large-scale purchases. And and this can be applied to physical as well. When you're deciding to buy, sell, trade, or hold right now, instead of making extremely large purchases, right away, you need to be able to learn how to nibble at it, like they said. That's a good metaphor. Nibbling at the markets, going a little bit at a portion you're buying off. Because what if you started buying right now, but then the price lowers and you could have bought a lot of silver for a lot cheaper? Or what if it rises and you sold yourself short? What if right now you start panic selling, and then it goes up a couple dollars within the next couple months? You sold yourself short. So you want to be able to, have a pulse on the market, keep a watchful eye over it, and then you can decide where to go from there. But if you're going to do it in portions. So in conclusion, investors should be prepared for choppy behavior from gold prices in the very near term, as the market remains vulnerable to coronavirus-related developments. Yet a bullish intermediate to longer-term outlook on the metal is reasonably certain based on historical connection between past financial crises. So they're saying that this intermediate, this 3 to 6 month term, is going to look extremely bullish for gold and silver. I'm extremely bullish on it myself, but even the past historical data shows this as well. So not to be a silver pumper, but gold and silver have a lot of potential over this next 6 months, and I hope that you guys are putting your positions in, diversifying your portfolio, and are ready to take advantage of this, because who knows how high prices can go. We're talking about $50 silver in 2011 last time this happened, and the stakes are a lot higher right now. So who knows how much higher it's going to go, whether it's $20, $30, $40, $50 to $100. Who knows? The stakes are definitely higher, so that means the outcome can be higher as well. So anyways, yet a bullish to intermediate outlook for the metal is reasonably certain based on historical connection between past financial crises and subsequent Fed QE efforts, quantitative easing efforts. The higher bullion prices, investors are therefore justified in maintaining a bullish intermediate term posture towards gold. So definitely bullish. So anyways, I would love to hear where you think in the next 6 months gold and silver prices are going to go. especially the gold to silver ratio. You know, gold compared to silver, not both going up a certain percent. But do you think gold's going to go up higher than silver, or do you think silver is going to be the winner, going to have the upper hand, and silver prices are going to be the ones to look for? That's definitely what I'm thinking. I'm thinking silver is going to be the big player in the game with the largest positioning, just because the given circumstances, the situations, the information, and the statistics backing it as well. So anyways, I'm going to wrap this video up here. If you did enjoy this video, make sure to smash the like button. The link to this article from Seeking Alpha will be in the description. So anyways, check out the video I posted earlier today, a couple hours ago. It's definitely a good video. You want to check that out, talking about the sanity that's going along with all this, trying to stay sane, but also where gold can really go, and silver, talking about $150+ silver in the next 6 months. So anyways, thanks for tuning in. Go check out the last video. Make sure to smash this like button as well. This was Silver Slayer. I'll see you guys soon. Peace.